Hello, fellow Rebel Capitals. Hope you're well. So the stock market is booming today. The Dow up over 1,000 points because the U.S. announced a temporary trade deal with China. My goodness gracious. And Jim Cramer is all about buy, 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 buy. In fact, all of FinTwit, even Zero Hedge, is talking about how this is going to lead to an economic boom and the stock market is going to continue to go higher and higher and higher and higher and higher and higher to infinity and beyond, baby. I mean, there is some serious euphoria right now, not just in the mainstream media, but even in the alternative media space, because now the alternative media, at least a lot of it, they're all about MAGA. So anything that Trump does well, that just means it's going to be awesome. And that's just, then they turn into Jim Cramer. So now everybody's Jim Cramer. Jim Cramer's Jim Cramer. Zero Hedge is Jim Cramer. The MAGA folks are Jim Cramer. So you have to ask yourself, how does this end, or how does it continue? Do we go up and up and up and up like everyone is predicting right now because we're getting these trade deals done? Or is this a bear market rally? I don't know. I can't predict the future, that's for sure. But what I can do is go over a couple indexes that you can use to come to your own conclusion that I think you will find extremely interesting. And spoiler alert, the first one is from none other than CNN. That's right. But it's one of the very few things that I've seen from CNN that is actually objective because it's based on options and whatnot. But check this out. This is the Fear and Greed Index. So we got the screen share going, Josh. Yeah, we do. All right. So I had heard about this, but I never really looked into it too much until yesterday. And I was going through and I was trying to find some sort of indicator that would be good for sentiment. Now, I found this and I found another one that I'm going to share with you guys here in just a moment. So make sure that you stay tuned. But I thought that, okay, it's CNN, but let me figure out what the inputs are for this Fear and Greed Index to see if it's got some merit, and then just do some back testing. So, okay, we've got the 125-day moving average. All right, that's legit. That's not politically biased in any way. It is what it is. And then we've got the stock price strength. So this is net new 52-week highs and lows on the NYSE. Okay, see why that would be useful. The stock price breadth. Okay. Put to call ratio. Yeah, that's a good one. We've got market volatility. In other words, the VIX. We all know that's important. Safe haven demand. So now we're looking at a ratio. It looks like difference in 20-day stock and bond returns. So I thought, that's actually a good idea to see how many people are selling, how many people are buying stocks versus how many people are buying bonds, treasuries, right? Because the more people that are buying treasuries, let's assume that there's 100 people buying treasuries and 50 buying stocks. Okay, well, would be extreme fear maybe. But let's just say it's vice versa. Okay, well, that'd be extreme greed because everyone is risk on as opposed to risk off. So I went through this. I'm like, this makes a lot of sense. The inputs that they have for this Fear and Greed Index. So then what I did, just some super basic back testing. I went and pulled up a chart, just try to find a chart where you could do the Fear and Greed Index versus like the S&P 500. So let's look at that. And I want to give credit where credit is due. This is marketnoise.net. And this is not up to date. This goes back to 2021. But it shows you that often when we hit these highs in the Fear and Greed Index, meaning we're at the extreme greed level, you see the stock market decline. It's a perfect contrarian indicator. Not perfect, but it's a very good contrarian indicator for obvious reasons. Everyone's on one side of the boat. And then what's really interesting is when we get to the extreme fear, that's actually more or has a higher accuracy than when you're at extreme greed as far as that inverse correlation. So right here, the first arrow, they could go back, but the first, and I don't know why they don't, because it doesn't look like it was too good here prior to 2000. Yeah, actually, yeah, it was still pretty decent as far as when we got into the extreme fear, although we weren't there too often. But like right here, I mean, when we get down to like lower than 10, hopefully you guys can see this on the right. It goes from, call it 10 is the lowest number, up to, it goes up to 90. So when you get below 10, I mean, look, you want to buy. I'm going to buy next. I mean, truth be told here, no, I don't know that I'd hold, for long term, but just for like a 2 week, 3 week trade, this looks very good, very tempting. As long as you got good stops and you got good risk management in there. And then when you look at the extreme greed, I wouldn't use this as a sole indicator, but I would definitely incorporate this into the mix for sure. You can see that in 2020, just ironically, before the cerveza sickness, we were at extreme greed, like almost 90. Look at that. And then same thing here, roughly, before we started down. So it's not a perfect indicator, as you can see, but I would use this along with your other macro inputs, as well as PE and kind of the more fundamental stuff. So this begs the question, okay, so if over 70, we're at the extreme greed point, and it might behoove you to be a little bit more cash, a little bit more dry powder. And then if below 20 is extreme fear, and that's what we saw like April 9th, April 10th, where are we right now? And then we go back to the index, and we were at 66. Now we were at 62 this morning. And because of the market action today at 66. So I don't know this. I definitely wouldn't go short because we're at 66, but I would wait. And if this thing gets up to like 75, then I'm like, all right, maybe, maybe I'm going to be in a lot. Let's just say you've got a normal portfolio, cash, equities, bonds, gold, commodities. Once we get up into this 75 range, that ratio for me would change quite a bit. I would be risk off right here, for sure. And then hopefully, I'm sure this year is going to be so volatile that at some time throughout the rest of 2025, maybe 2 or 3 times, we'll probably get down to where that extreme fear, at the 10, 12, maybe 8 mark on this index. And that's when you go in there and, hit me. Then you take some of that cash and you could back up the brinks and you have a good little short-term trade. So does this completely answer the question as to whether or not the stock market's going to continue to go higher and higher and higher, or if it's going to roll over and this is a bear market rally? No, this isn't. This is not a video making a prediction or coming out and saying that this is the be all end all. It's just something that I discovered that I want to share with you that I think you guys would find interesting, that I'm definitely going to add into how I set up my portfolio, especially more short term. And on that note, I'm going to go ahead. I made some huge changes to my portfolio. I have a couple model portfolios in Rebel Capitalist Live, and they've been quite boring for the last year. So because the majority of the portfolio was just gold and T-bills, which by the way has done extremely well. most people made fun of me for having those portfolios and like, oh, George, you're missing out on all these gains. You're missing out on all these gains. Yeah, I am. But when you look at all these gains, in fact, let's do that. Let's go over to the S&P 500, which absolutely is up huge over the last couple weeks. That's for sure. But let's not forget, we're still way down on the year. So if we do a year, I wish, CNBC would give you the percentages based on which chart you pull up, but for some reason they don't. But I've actually got that on my phone. So if you guys just bear with me one moment. So the S&P 500 is up, okay, 12%, including today, for the last year. My T-bills and gold up about 12, 13%. And in the one portfolio that's just strictly T-bills and gold. So did I have the downside though? Did I have the volatility? Absolutely not. Now, just year to date, the S&P is down 0.42%, including today. And I can assure you the gold and T-bill portfolio is up a hell of a lot more than that. That is for sure. But anyway, bottom line is I made some huge changes to the portfolio today that I'm really, really excited about. So I'm going to do a webinar this Friday. I haven't done one of those in quite a while. I'm going to do another one this Friday for the Rebel Capitals Pro members. So if you want to check that out, you can just go to georgegammon.com/pro. Just do the $1 trial and you can snoop around, check it out, see if you like it. And then you can join me and get access. If you can't join me, you can get access to that live stream that we do on Friday morning where I go over all these big changes that I've made to the portfolio. And I'm going to go over why I've done them as well. That's going to be this Friday, 11 a.m. Eastern time. So again, if you want to have access to that, go to georgegammon.com/pro. And you can either sign up or just do the $1 trial and see if you like it. Okay, getting back to this chart here. This is the big question, right? When you look at this chart, it's like, okay, is this going to lead to us going straight up to all-time highs and exceeding that, similar to what the Bitcoin chart looks like, by the way? Or is this just, one of these typical bear market rallies that just rip your face off and then reality sets in and it's like, oh, it's not as good as we thought, and then rolling right over. So you have to think, now we're at a point where all of these deals, these trade deals and the tariffs and everything that Trump talked about on Liberation Day, it's priced into the market that that's all going to go away. And let's remember the deal today with China, and I should definitely pull that up here real quick. The deal with China, if you guys haven't heard, it's great. I think this is awesome. But the fact of the matter is it's just a pause. This is not a trade deal. And they agreed to, I think, reducing the reciprocal tariffs or eliminating them just for 90 days. So Chinese officials, influencers, state-run media on Monday were casting the initial trade agreement 90-day tariff pause. And do I like that? Absolutely, I do. I think that's fantastic. But it doesn't mean that we've got a trade deal. We've just kind of paused, which, if you think about it, it behooves, regardless of what happened, this was probably going to be the result, because China's economy is in the toilet. They're trying to increase aggregate demand. The United States economy is softening, and Trump needs a W some way. So they probably, that's the first thing they talked about before they went to lunch. And there was like, oh, the Chinese left after 2 hours. Probably what happens, they sat down and they're like, look, regardless of what happens today, let's agree that we just do a 90-day pause, because that's going to give you a big political win. That's going to give us a big political win. And then we'll try to, in the interim, sift through kind of the details and see if there's something we can agree on. That is the most level-headed thing that both parties could have done. And it seems like that's the outcome here, because now look at the headlines, right? Trump can take this back and tell everyone that he's has a huge W and that we're beating China and this is a great deal for the United States. And China can do the exact same thing. Right here, China sees the U.S. trade deal as a huge win for Beijing. Okay, is it a huge win for Beijing, or is it a huge win for the United States? Now, I think reducing the tariffs down to zero, basically, would be a big win for both. I don't want it to seem as though I think this is a zero-sum game, because I don't. I think both parties can win. But the way the way Trump sets it up, let's say, the way the Maganomics work is it's in order for the U.S. to win, China has to lose. They look at things from a very, very limited pie instead of the pie growing, right? Or I guess zero-sum game, would be a better way to phrase that. So my point is, this is now it's not even that the pause is baked in. It's like now we're baking in trade deals across the board. So we got a kind of a best case scenario here. So what happens if the trade deals don't pan out in 90 days, or if we don't have another W, or if tomorrow the CPI comes in very, very low, and then we start seeing the initial claims spike, and now all of a sudden you've got kind of perfection, if you will, that's priced into the market, and you could see that thing roll. Especially when you go back to the fact that you're very near euphoria in the market right now. So I don't know which way it's going to go. I mean, the chart looks pretty decent, but I would be very concerned here. And where is the chart? And I would be probably taking some risk off the table. If it were me, I would be taking some risk off the table. Well, if it were me, I'm very content to be in T-bills and gold, in addition to the big change that I made in the portfolio. Huge change. It's kind of weird because over the last year or so, it's been pretty much the exact same. I haven't done anything to it. And now all of a sudden it's things are starting to roll. And I'm really excited about implementing this strategy while I'm waiting for things to play out in the market. But anyway, we'll go over that on Friday. Now let's get over to another sentiment indicator that I wanted to share with you guys that isn't really actually it is. I was going to say it isn't really applicable to what's happening today, but it absolutely is, because we've been talking about the stock market, but we had a huge move in the United States dollar right here. DXY. Come on, load, you stupid thing. Come on. Maybe it's because I have 45,000 tabs open. Might have something to do with it. Well, the DX page unresponsive. Josh, how do I fix this? You're Gen Z. Here we go.
You got it.
Okay. So look at this. The dollar almost back up to 102. I mean, how long ago was it? A week and a half, where everybody was coming out and saying that the dollar is going to crash and the dollar is going to be confetti within a month because all these foreigners are dumping dollars. And I don't want to pick on Schiff because he's a good buddy. But remember, Peter was in a state of euphoria. He's like, the dollar's crashing. I told you it was going to happen. And now we're back up to 102. Now, I don't want to take a huge victory lap, although I predicted that we would have a snapback. I don't want to pat myself on the back too much here, because we had a snapback for sure. But I think we kind of had a snapback for a different reason. Or a reason, there's probably multiple reasons, but one of the reasons is not something I predicted. And so the reason I thought we'd have a snapback is because you have all these foreigners that, let's just say they're dumping dollars or whatever, cause the dollar to go down. Then you have all those foreigners that have that dollar debt, they have the dollar inputs, they have dollar liabilities. So they have to pull up those dollars, which makes the dollar kind of revert back to where it was before. Especially if liquidity is drying up. Dollar liquidity, that's going to make that snapback really quick. I think the reason why we didn't see a snapback earlier is because dollar liquidity actually wasn't that bad in the euro-dollar system. But now we're seeing that get back up to 102, obviously, because everyone is buying U.S. assets again. Because, you know, we've got the trade deals, no more tariffs. Everyone is Jim Cramer. Zero hedges Jim Cramer. And therefore, buy, baby, buy. And everyone needs dollars, so the dollar is going to increase because they need those dollars to buy U.S. stocks. Now, we'll see how long this continues. I actually would be my base case that the dollar might go up a little bit more here, but it might head down because I just like the 2-year right now. I know I'm bouncing all over the place, but this all kind of ties in. The 2-year way up today at over 4%. So on the day, we're up over 10 basis points, huge move, which tells us that the odds of at least the market odds for the Fed dropping rates are have been dramatically reduced. So I think this is not my base case, let's say. Therefore, now that this is being priced into the dollar, I think fast forward 2 months, if this changes and goes down to, let's say, 3.8 or something like that, kind of rolls over along with expectations for Fed cutting rates, then I think that could bring the dollar back down. But then it's all about dollar liquidity. Because if dollar liquidity dries up for something else, then the dollar is going to rip higher because of the way the global monetary system is set up. But anyway, getting back to the whole market sentiment thing, this is my FX book. And I thought this was really cool. I'd never seen it before, but this tells you kind of retail, from what I understand, this kind of retail positioning around FX pairs. So you've got euro dollar, you've got pound dollar, dollar yen, pound yen, US CAD, euro Aussie dollar, euro yen, and it actually has gold in here as well. It is I don't know if it's on this chart. It might be on a different one. But this is it right here. This is gold in British pounds. So you can see that gold in British pounds, everyone is, what would that be? They're long gold. 97%. Wow. So, I mean, obviously, over the longer term, I like gold a lot more than the British pound. But boy, for a short-term trade, I mean, everyone's on one side of the boat here. Although it's not too many, they're only tracking 13 positions. So it's not like they've got a big sample size here. Let's look at my guess is euro dollar. Oh, look at this. Yeah. The positions here, you've got 37,000. Wow. Okay. Yeah. So be careful with it. Make sure if you use this, you're looking at the positions, the number of positions they're using to come to this ratio. Because if it's only like 10 or something like that, then who knows? But if it's 40,000, then I think this would hold more weight for me for sure. But I know they do gold in dollars. Let's see if that's on the same thing here. XPT, I'm not sure what that is. You guys will have to play around with this. I'm almost sure gold is XAU. Why is it the gold dollar not right at the top? Oh, is this it? This might be it. I think this is it right here. So here you've got 700 positions and 800 positions, so a little bit bigger sample size. And don't quote me on this one because I've just started fiddling around with this, but I believe this is gold. So there's about 50-50 as far as short positions, long positions, 54%, 46%. But if this was all the way over here or all the way over here with a big sample size, just over the short term, it might be interesting for a trade. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. And if you want to join me on that webinar this Friday, where I'm going to go over some big changes I've made to my portfolio. And by the way, this is not paper trading portfolio. These are actual real portfolios. One of them started with $100,000. The other one started with $300,000, where I'm putting real money to work. It's not fake and pretend, and it's not a video simulation, right? So I got some serious skin in the game here, 400 grand worth of skin in the game. But if you want to participate, go to georgegamma.com/pro, and you can sign up, and we will see you Friday. And you can't be there live. If you're a member of Rebel Capitalist Pro, you have access to it. It's right there on the homepage, so you can watch the replay. Okay, guys, on that bombshell, we'll see you on the next video.